Welcome to Traders Expo 2017 here in New York. I'm Matt McCall, joined by Rick Swope, Pro Market Advisors co-founder. Rick, thanks for joining us today.
Appreciate it. Looking forward to always joining these events.
Good to see you, and the business partner earlier.
As well.
Let's talk a little bit about risk management. I know you just had a speech on that, so let's talk about what you kind of shared with them. We'll share it here in video.
Sure. You know, I always like to open up by explaining what drives us as traders. And there are two things that people don't really recognize, but it's a part of our trading, and that is risk aversion and loss aversion. And so let's take risk aversion first. You buy a stock for $75, it goes up to $75.50. Now you have a profit. You don't want to risk the profit. So what do? You sell that stock too early. You're minimizing your gains. On the flip side, there's loss aversion. And loss aversion says that when you have a loss, you'll actually gamble with a loss in order to avoid it. And so you buy the stock at 75, it goes down to 74, it's at 73, it's at 70. You'll ride that loss. Why? Because you're loss averse. So when you understand this idea of risk aversion and loss aversion, this actually drives a lot of what makes our trading decisions.
So a lot of people, I can't agree more with you, is that based on emotions? I know when you go to bed at night, you're not concerned about the stock that you bought at 75 is at 70.
Exactly.
Hey, it's okay, it's going to come back.
Yeah.
You're concerned about the one that went from 75 to 76. My goodness, I don't want to lose that dollar gain.
That's right.
Why is that? How do we change that?
Well, I don't know that we could change it. I think what we have to do is we have to recognize it and accommodate it.
Okay.
And the way that I explain it is you have to get away from an emotional decision and go to a disciplined decision, because it's counterintuitive. In fact, I do this little quiz that illustrates risk aversion and loss aversion. Just did it earlier today in the session, and it is without exception. Everybody falls prey to it. Everybody always locks in their gains too quickly because they don't want to risk it. And then they let their losses ride. And they'll oftentimes let the loss ride to an extraordinary amount, because the old saying, a loss isn't a loss until you sell it.
It is true, but it's still,
it's still a loss.
I hate to say it, but that's a loser talking to you. That's the guy who's got a loser,
That's right. That's exactly right.
The winner's not going to say that.
That's exactly right.
Yeah.
And so what we have to do is we have to have a discipline in place that forces us to stay into winning trades and forces us to get out of losing trades. And it's counterintuitive.
So at what point do you say, okay, I've made enough, I'm not going to get greedy, I'm not going to become a pig, and get out? Or is there maybe a stop loss strategy? How do you do that?
Exactly. There's several strategies. The most basic is the stop loss strategy. We actually prefer the trailing stops. Okay. And even more specifically, a technical trailing stop. The way I describe it is don't try to figure out when to get out, let the market tell you when to get out. The market will tell you it's had enough and get out. And that might be with a Bollinger Band or with a moving average. There are a whole variety of different tools. But it's kind of like surfing. How long do you stay on a wave? Till the wave breaks.
The wave's determining how long you stay in that, right?
That's right.
And the market's going to determine how long you stay in that trade.
That's exactly right.
All right, that's great advice. Rick Swope, Pro Market Advisors co-founder, thank you very much for joining us.
Appreciate it.